Welcome to The Debate. Today, we're diving deep into a really critical issue for retirees: how to handle those significant pre-tax retirement accounts. And the central question, it's a high-stakes one, really. Should retirees go big, aggressive, large-scale Roth conversions now to lock in today's tax rates and, head off future distribution risks? Or does the complexity of the tax code demand, surgical precision, maybe even restraint, to dodge these immediate kind of hidden penalties that could actually cost them dearly?
I'm firmly on the side of decisive, proactive action. You need to take control. And I see it quite differently. Look, the allure of tax-free growth, I get it, it's powerful. But the path you're advocating, this, let's call it the aggressive approach, honestly, it's just littered with potential traps. My stance is that the sheer complexity and, frankly, the punitive nature of some of these immediate tax penalties demands, maximum analytical restraint. Converting too much, sometimes literally by just $1, can completely undermine the intended benefit and fast, like within 2 years.
Okay, let's talk about the cost of not acting, though, because in my view, retirees are frankly sleepwalking into a massive, avoidable expense if they just stick to the old strategy of, waiting for required minimum distributions, RMDs, to force their hand. We ran the numbers. Take a hypothetical couple, okay? They've got a $1.9 million pre-tax nest egg. If they follow that standard wait for RMDs path, our projection shows they're looking at about $1,275,000 in lifetime taxes. That's an average tax rate of 18.4%. Now compare that if they instead strategically execute Roth conversions year after year, deliberately filling up, say, the 24% tax bracket during their early retirement years when income is often lower. Well, they could potentially slash their total tax bill by around $631,000. That brings their effective average rate down to just 11.2%. That $600,000 plus difference, it's essentially like leaving a massive voluntary tip for the government. It just proves the urgency, doesn't it? Maximize conversions while your marginal rates are predictably lower.
That's definitely a compelling argument based on those future tax bracket projections. But, and this is a big but, have you really factored in the immediate known costs? The ones triggered by that very aggressive conversion income you're advocating. Because the fundamental flaw, as I see it, in pushing conversions right up to a high bracket like 24% is the failure to account for what I call the hidden tax trap of IRMA surcharges.
I see why you'd focus on that, but IRMA, look, it's a manageable detail. It's something you factor into the equation. It shouldn't be a complete roadblock stopping someone from potentially saving over $500,000 in taxes. Surely.
I'm sorry, I don't buy that it's a manageable detail when the penalties are so significant and hit so quickly. Let me explain why. IRMA, that's the income-related monthly adjustment amounts for Medicare Parts B and D, it's based on your modified adjusted income, your MAGI, from 2 years prior. A Roth conversion, especially a large one, dramatically inflates that MAGI. We looked at a case study, Bob and Sally. Their seemingly rational conversion plan pushed them just over the first IRMA threshold. What happened? Their combined annual Medicare costs jumped by over $5,800. And the trigger is crossing that MAGI threshold, which for 2025 is $212,000 for couples, by even a single dollar. That steep, immediate penalty hitting them just 2 years later, it can completely negate the benefit of thousands in supposed future tax savings. The only sensible strategy has to be threshold aware.
Okay. This is exactly the tension, isn't it? The long-term tax mitigation versus these immediate, potentially costly pitfalls. But you seem fixated on, let's be honest, an administrative penalty while potentially ignoring the ticking time bomb of RMDs. Starting at age 73 or 75, depending on birth year, RMDs are mandatory. They increase every year. They will force large distributions eventually, potentially pushing retirees into the 32%, 35%, even 37% tax brackets. That's almost guaranteed for large balances. And it gets worse. Think about the severe widow's penalty. When one spouse passes, the survivor is suddenly using single filer brackets, which are much smaller. That accelerates the tax problem dramatically. Roth conversions, they eliminate RMDs entirely. They ensure tax-free growth. They stop that forced future taxation. That's control.
That's control in a vacuum, maybe. The current tax environment isn't just about future RMDs. You're kind of glossing over the fact that Roth conversions increase what's called provisional income. That's the specific number the government uses to figure out how much of your Social Security benefits get taxed. So, doing large conversions can make a much bigger chunk of your Social Security taxable today, not maybe someday, today. And what's more, that extra income from the conversion, it can easily push your long-term capital gains out of the 0% tax bracket. So, the known, immediate, and frankly high costs of an IRMAA surcharge, plus potentially higher taxes on Social Security and capital gains, these must be prioritized over hypothetical future tax rate hikes. The optimal strategy isn't convert aggressively. It's converting just enough, staying meticulously below those critical thresholds to get the long-term benefit without triggering the immediate pain.
I agree precision matters, I do. But let's just step back for a second and address the core skepticism in your argument. This idea about whether people can actually execute some perfect multi-decade plan. Look, the diversification motive here is powerful precisely because future tax policy is so uncertain. People are responding rationally to current incentives. The data shows, somewhere between 30% and 55% of people doing Roth conversions, they don't convert their entire traditional IRA balance. That's not confusion. That's a calculated strategy. It's diversification against future tax rate uncertainty. They're actively managing the risk that rates could go up, especially with the current tax cuts potentially expiring in 2026. That's a real deadline.
Okay, I fully agree that diversifying your tax exposure is crucial, but let's look at what the data actually shows about people's ability to execute these plans. You're asking retirees to pull off a complex, multi-decade optimal strategy when evidence shows we struggle even with simple, short-term decisions. Remember that policy change back in 2010? People converting could choose to recognize the income right away in 2010 or spread it over 2011 and 2012. A straightforward 2 to 3 year forecast, right? Well, guess what? About 31% of them made the wrong call in retrospect. The median extra tax they paid because they guessed wrong? Around $320, or maybe $500 depending on how you discount it. If people struggle with a simple 2-year forecast, how can we realistically expect them to perfectly map out their marginal tax rate over a 30 or 40-year retirement window? That lack of mechanical understanding, that failure to execute optimally, it doesn't just apply to tax planning, does it? This whole conversation, it really highlights a massive execution gap I see all the time. Most retirees, even those with substantial accounts, $100,000 in an IRA, $250,000 in a 401k, even millionaires, they get that they need to diversify their assets too, especially now, to protect against economic uncertainty, inflation. I mean, look at central banks. They're accumulating gold at rates we haven't seen in 50 years. So people know they should consider hard assets, things like gold, but they often have absolutely no clue how to actually add something like that to their retirement accounts. The mechanics, the rollover process, what does it really cost? It's a total black box for most people. And that's exactly why we put together a comprehensive free gold IRA guide. It's linked right there in the description.
Actually work. What are the real costs involved? The 3 simple steps to get started, which honestly, once you understand it, can take maybe 15 minutes. So if you've got at least $100,000 sitting in an IRA or a 401k or other retirement accounts, this guide really shows you exactly how the wealthier investors, the institutions, are positioning themselves right now. It addresses that very execution complexity we're debating.
That's an interesting point, connecting the tax planning complexity to asset allocation complexity. Though I might frame it slightly differently, the need for proactive financial action, whether it's tax planning or asset diversification, that's exactly what drives successful investors, right? The data shows taxpayers are responsive when the incentives are clear. Remember that stat? A 10 percentage point drop in the marginal tax rate is linked to a 25% increase in Roth conversions. People are actively managing the timing. So the mechanical risks you bring up, yes, they're real. But they're risks of inaction just as much as risks of misaction. And the absolute key mechanical success factor for Roth conversions remains paying the conversion taxes from outside the IRA. Use money from a taxable brokerage account or savings. That move maximizes the principal left inside the Roth to grow tax-free, compound tax-free.
generating a vastly superior long-term return compared to leaving that tax money in the IRA or even in the taxable account.
But that just ignores the very real barriers to entry and the specific mechanical pitfalls that catch even savvy investors. Look at the take-up rate. Only about 3.3% of eligible IRA holders have ever done a Roth conversion. That strongly suggests the complexity is a major deterrent. And even if they manage to pay the tax externally, they still face the mandatory 5-year rule. And let's be precise here. Converted funds have to stay in the Roth for 5 full tax years. If you pull out the converted basis before age 59 and a half and before that 5-year clock is up, you could face a 10% penalty. And we haven't even really touched on state income taxes. So many converters just forget or underestimate the state tax hit. It applies immediately right alongside the federal tax and can significantly balloon the total upfront cost, especially in states that don't automatically follow federal tax rules.
If you convert $100,000, you're paying that state tax bill now, and that has a serious impact on your cash flow.
Look, at the end of the day, the data strongly suggests Roth conversions are an incredibly powerful tool. It's about taking control of your future tax liability, reducing costs for your heirs, and preventing the severe lifestyle impact of those ever-increasing RMDs, especially when future tax rates are so uncertain. The risk of getting trapped in unexpectedly high tax brackets down the road, that's the immense, irreversible opportunity costs we are trying to help people avoid.
And I acknowledge the potential power of the Roth. I truly do. But it is absolutely not a strategy for the complacent or for those who aren't willing to get into the weeds on the technical details. The numerous, immediate cost hurdles, especially IRMA, and how conversions affect the taxation of Social Security benefits, they demand surgical precision. So the lesson isn't convert aggressively at all costs. It's convert with maximum analytical restraint. Make sure every single dollar you convert stays below those critical penalty thresholds.
Which, I suppose, brings us right back to the core tension: scale versus safety, bold action versus meticulous caution. The optimal strategy is, of course, highly individualized. It depends not just on projecting future tax rates, but critically on your willingness and, frankly, your capacity to manage these intricate, immediate tax penalties.
Reinforcing the absolute value of seeking expert, truly holistic planning and doing it now before those RMDs kick in automatically and before that potential $600,000 tip, as you put it, is irrevocably sent to the government.